Welcome to our 5th unit in recording financial transactions. In this unit, we are going to look at receiving money and the banking system. Receiving money and the banking system. So businesses operate, businesses make sales, and business also make payments. So we are on one side of making sales. How do we receive cash into the business? And how do we post that in the banking system? So one of the most important tasks in a business is to collect and record amounts due from customers. To record amounts that are due from customers. Now in this unit, we are going to look at a number of items, 7 in total. Number 1, we look at the banking system in Rwanda. Number 2, we look at remittance advice. Whenever you are banking money, you have sent your messenger to go and bank money in the bank. There is a document you give him. That document is called a remittance advice that he will give to the teller so that the teller knows which amount goes where. The banking, cash. What are the protocols we put in place when we want to bank cash? How do we deal with checks? How do we deal with receipts of debits and credit cards payments? In today's transactions, we use a lot of debit cards and credit cards. And we should also know what is the difference between a debit card and credit card. There is a clear difference between debit and credit card. Next, electronic receipts. Sometimes when you make payments, you are provided with a receipt. Or when you sell to a customer, you give a customer a receipt. So we'll be looking at electronic receipts. And then it is important to retain all your documents, because you can sell to a customer and then after 3 months he comes back and claims something. So how do we retain documents? We'll look at something called a retention policy. So let's start covering the items one by one. The banking system. Now, there are various ways that a business can receive money. There are different forms or ways a business can receive money. However, the main methods are, number 1, you can receive money through cash, where you have received notes and coins from a customer. That is receipt through what? Cash. Receipt through notes and coins. You can receive through a check, where the customer has written to you a check, and you must deposit the check with the bank, to the bank, so that you get your money directly into the bank. Number 3, you can receive money through credit and debit what? Cards, where somebody makes payments to you. You receive through credit and debit card, and there are other electronic receipts systems. You can receive through other electronic means. So there are, majorly we have 4 different ways of receiving money. Now let's focus in Rwanda. The banking industry in Rwanda. What is that cycle? What is the link between the banking institutions in Rwanda? The banking system in Rwanda consists of 3 major banks. Number 1, there is the regulator of banks in Rwanda, which is called the Central Bank, or BNR, the National Bank of Rwanda, which is at the top. It regulates all commercial and investment banks, so long as somebody deals with money. A financial institution that deals with money, they must be regulated by the National Bank, which is the central bank which controls these banking industries. Now below the central bank, now we have the different banks, retail banks, investment banks, we call them clearing banks. And we have quite a number of clearing banks. We have Bank of Kigali, we have Koje Bank, formerly Koje Bank, now it's called Equity Bank. There is, because Equity Bank bought Koje Bank, there is the BPR, which was bought by KCB. So BPR and KCB are now one. And we have other major banks. We have NCBA, Access Bank, GTB Bank, All those are clearing banks. And then we also have microfinance institutions where the peasants and people with small amounts, those who are not in formal employments, it can help them save and borrow money. Those are microfinance services, which are a type of banking service that is provided to unemployed or low-income individuals. So there are three major lines of banking under the banking system in Rwanda. At the top, we have the BNR, the National Bank of Rwanda. Remember, that's the central bank in Rwanda that regulates all the other banks. And then we have the clearing banks, and we have microfinance. Now, how do we clear checks, or whenever there is any payment to be made through the bank? What is the procedure that we follow? What is the clearing system? Take note. Clearing is a mechanism for obtaining payments for checks. So when I deposit, a customer has given me a check. I have that check, I must take it to the bank so that that bank clears and I get money into my account, or sometimes I get cash. Either you can receive cash when you deposit a check, or the money can be transferred to your account. What is the procedure that we follow? So clearing is the mechanism for obtaining payments when you, for example, have a check. Banks settle checks and credits through the clearing system. The point is this. Remember, we can have a check from Bank A directed to Bank B. For example, there is a check from Equity Bank, and that check is being taken to Bank of Kigali. So there is a way. If there is a transaction that affects two different banks, at the end of the day, BNR comes in. The central bank comes in as the clearing house. So banks settle checks and credits through the clearing systems. Once the values of checks passed between the banks at the end of a particular day's clearing have been determined, the resulting debts arising between the banks need to be settled. So remember, maybe Equity Bank owes Becca at the end of the day maybe 100 million, because there are thousands and thousands of transactions. So we need to clear this difference. In short, at the end of a day's banking, banks owe money to other banks and are owed money in return. So Becca may owe Equity and Equity may owe Becca. These debts are settled through accounts which the banks maintain at the national bank, at the BNR bank. So all these differences are reconciled through BNR. What are the banking services that we have? In the traditional way, there were two major types of services. We had only what we called a current account, and we had a savings account. But today, we have other services offered by banks. For example, we have credit cards. Banks deal with credit cards. Number two, we have investments. Banks deal with investment. Share dealing. Banks deal with shares. Banks deal with loans, giving out loans. Banks nowadays, they have subsidiaries or branches that deal with insurance. Banks deal with home insurance, travel insurance, and Forex is also a major service in banking, foreign exchange, pet insurance, wealth, etc. The point is, today we have very many services offered by banks. Before, we used to have only current and savings accounts. But today, we have many services. In our second item, we have what we call remittance advice. Remember, we are dealing with receiving money. So what is a remittance advice? A remittance advice shows which invoices a payment covers. So if there is a check you have sent to the bank, you should clearly show the bank which payments should be made. So trade customers usually send a remittance advice with their payments. When a check arrives from a trade or a business customer, it is usually accompanied by a document that explains the breakdown of how the payments should be made. For example, if there is a company called LB, sends a check of payment of 37,360,000 to NT company, this payment is accompanied by a remitted advice note explaining the invoice and the credit note that the payment relates to. So the total check you send to the bank is 37. And there are a number of employees to be paid, or there are a number of customers to be paid. So a remittance advice will show you which clients to pay and how much to pay them. Banking cash. Companies or businesses deal with cash. What are the protocols or what are the procedures we need to follow whenever we are banking cash? So cash comprises of notes and coins, which make up the legal tender of a country. So cash can either be in note form or it can be in coin form. So when banking cash receipts, what is the procedure you follow? Cash must be properly counted and sorted. If you are going to bank cash, if you are the one going to the bank, you must confirm. You are not just given the cash by the accountant and then you just go without confirming how much cash you have. You must count and sort it out. Sorting is in different denominations. Maybe your cash, we have notes of 5,000, notes of 2,000, notes of 1,000. You must sort them in order so that you know that the 5,000 notes were 20. The 2,000 notes were 100. The 1,000 notes were maybe 2,000. Notes and coins must be listed by denomination. 5,000, 2,000, 1,000 in that order. Now, a float is the money kept in the till at the end of the day so that the next day there is some cash available to give out to customers. Whenever you are dealing with cash, don't bank everything. Or if it's a bank, the bank will not issue out everything. They must keep some cash in a till so that tomorrow morning there is cash that can be given out. If it's a business does not take all the money to the bank. They must retain some money in the business so that tomorrow morning there is some money that can be used maybe in petty cash transactions. So we must not always bank everything. We must always keep money. So what are the procedures we follow when preparing a paying in slip? When you want to make payments, what are the procedures that you follow? Paying in slip, you want to pay somebody. The following procedures are good practice to follow when preparing money for what? Banking. Before you bank, what are the procedures we need to follow? Number one, or step number one, count the cash as described in the previous slide. You must count so that you have the notes, you know how much cash you have. Once you have counted the cash and you are sure of how much cash you have, maybe the total cash you have is 10 million to be banked. Step number two, add up on a separate piece of paper how much cash you are banking. So you decide now, you add up and you record it somewhere. How much am I going to bank? Is it 10 million? Is it 5 million? etc. The third step, compare the calculated total to the total according to the cash what? Register. Maybe the accountant told you that you are supposed to bank 10 million. But whatever you have counted gives you 9 million. So there is a shortage of 1 million. That is why it's important to compare. The next step, calculate any discrepancy. Find out what is the discrepancy. Yes, he told me it's 10 million. And according to my counting, it is 9,800,000. What is the discrepancy? 200,000. You must find out what caused this discrepancy. That is step 5. Enter the total for each denomination of note in an appropriate place on the paying slip. So you must enter each denomination somewhere. And in most of the slips, banking slips, at the back of the slip, there is always the denominations. There is a denomination of maybe 5,000, 2,000. So you just write under 5,000, there are 20 notes. Under 2,000, at the back of the slip. Under 2,000, maybe 100 notes. Under 1,000, under 500, the number of the notes that are there. And number 6, add up the numbers again to check the total and enter it in the total cash box. And enter it in the total cash box. Let's look at checks. Payments today are made through checks. We should avoid cash payments. Now, what is a check? A check is an unconditional order in writing addressed by a person to a bank. So it's an order from maybe my business to the bank, asking the bank to pay maybe some supplier. So it may be me taking it to the bank or the supplier collecting it from me and going to the bank. So it's an unconditional order in writing addressed by a person to the bank, signed by the person giving it, requiring the bank to pay on demand a certain sum of money to the order of a specified person or bearer. So it's a document that you write. It's unconditional order to the bank, directing the bank to pay a certain amount at a certain time to a certain client. There are 3 parties involved in a check. Number 1, there is the drawee. Number 2, there is the payee. And number 3, there is the drawer. Number 1, there is the drawee. Number 2, there is the payee. And number 3, there is the drawer. So let's start with the drawee. The bank that has issued the check and will have to pay the check. Maybe in my business, my bank is Bank of Kigali. So the check is named Bank of Kigali. So Bank of Kigali is the drawee, the bank that has issued the check. Who is the payee? The person to whom the check is being paid, e.g. the supplier. So if I write a check to a supplier, the payee is the supplier to be paid. And finally, who is the drawer? The person who is writing and signing the check in order to make the payment. Who is, maybe I'm the one who is now the drawer. I'm the one writing and signing the check. I'm called the drawer. The drawee is the bank who the check is from. And the payee is the person going to receive the payment. So in our next slide, we are looking at receipt of debit and credit cards payment. We must start by looking at what is a debit card and what is a credit card. The 2 cards, they even look the same. But a debit card deducts funds directly from checking what? Accounts. So if I have a debit card and I slot it into the system, into the machine, the money is collected directly, instantly from that card. On the other hand, a credit card allows you to borrow money up to a certain what? Limit. So it's a card, but you will repay later. So it allows you to withdraw money from that card, but the payment will be later, of course, at some interest. So that is a debit and credit. Now, electronic receipts, payments electronically, online. So customers may choose to transfer monies owed to another business by other electronic methods of transfer. Electronic transfer methods includes what we call BACS and what we call CHAPS. Let's start with BACS. What is a BAC? In full, it's a banker's automated clearing system. A BACS is an electronic payment what? System. Banker's automated clearing what? System. There is another system called CHAPS. Clearing House Automated Payment what? System. So take note that a direct credit is a deposit of money by a payer directly into the payee's bank what? Accounts. So a direct credit is a deposit of money into the payee's account. Direct credit payments are usually made electronically. This method may be used by businesses when they pay salaries. So it's a check-off account where we pay money directly. For example, through when we are paying salaries. The last item is on retention of documents. Remember, we have said we need to keep our records right because there can be claims in future. So in the event of queries regarding individual transactions or bank accounts credits, the retailer will need to produce relevant copies of receipts. So it's important to keep these documents. It is therefore essential that all receipts are kept in a safe place, preferably in a date order, so that it enables you to sort out whenever you want to extract a certain receipt from where you kept it for a minimum period of 6 months. But we normally say every company has got what we call a retention policy. In the retention policy, it clearly dictates how long we should keep records. How long we should keep records. And that brings us to the end of this unit number 5. Unit number 5 was dealing with the receipt of cash and the banking system. The next unit will deal with now payments. This was receipts. The next units will deal with payments. Let's meet in our next unit. Our next unit will be unit number 6. Thanks, and let's meet in the next unit. Welcome back to recording financial transactions. In this session, we are going to focus on Unit 6. Unit 6 looks at authorizing and making payments. In the previous unit, we had looked at receipts, receiving cash. Now we are looking at making payments. So we are focusing on authorizing and making payments. Now, businesses need effective and secure methods for paying, for making payments due to suppliers, employees, and other payables. So how do we need to put in control? How should we control what is being paid? So in this unit, we are going to focus on 7 areas. Number 1, we look at controls over payments. Payment is a sensitive activity within the business which can be misused and leads to fraud. Number 2, when is the timing and methods of payment? At what point should we make payments, and which methods should we use to make payments? Should we pay through cash, through we have credit, should we use bank services, etc. We'll look at the option of now payment by cash, payment by check, payment by what we call standing orders and direct debits. There is a difference between standing order and direct debit, which we will focus on. And then we look at automated credit systems. And finally, we look at documentations to go with payments. Whenever we are making payments, there must be supporting documents. So these 7 areas are what we will cover when we are looking at making payments. So number 1, the first subtopic is controls over payment. Before you make any payment, there are some controls you need to put in place. So it is very important to apply the controls over payment. Which controls do we need to put in place? Number 1, there must be what we call supporting document to back up the payment. The supporting document can be like an invoice. So before any payment is made, there should be an invoice. Number 2, authorization of the expenditure. There must be a manager or chief accountant to authorize the payment before it is done. Number 3, there should be what we call authorization signature for checks. So if we will be writing a check in the business, there must be somebody who has been approved and authorized to put in their signatures in the check. And lastly, number 4, secure controls over electronic payments. So if it is not cash and check, if we are using other forms of electronic payments, e.g. maybe if we have a standing order or a direct debit, in this case, we should put in some controls to ensure we manage the payment. So lastly, it is important to establish proper authorization procedures so that we manage the payment services. Which are the steps that we follow, that we apply in making payments? Number 1, obtaining documentary evidence. That's the first step when you want to make a payment. So documentary evidences is what document that allows us to make the payment. I gave an example in the previous case of having an invoice attached to the payment, to the check. Number 2, authorization of the payment, which means there must be a senior official who allows the payment to take place. He gives his authorization by maybe signing a payment voucher or signing a document within the organization that allows the payment to take place. And number 3, restricting authority to actually make payments. There must be somebody specifically in the business whose job is to make the payments. Not everyone can make the payments. The timing and methods of payment. Now, suppliers in this case, if we are dealing with suppliers, normally gives an invoice, and sometimes the suppliers can give a credit period. They say that this payment must be made within 1 week. This payment must be made within 1 month. This payment must be made within 2 months. So suppliers give you the credit period, which must be respected by the business. Now, before we look at that, a business will use a variety of methods. Remember, we were looking at timing and methods of payment. So what are the different methods of payment we can use? The business can use cash for minor expenditures, spending here and there. We can use checks. We can use electronic transfers. Now, we have said suppliers usually dictate the period of payment or the timing of payment depending on what has been stated in the invoice. So decisions about who should be paid and when are made by senior persons within the business. So in that case, to help in decision making over timing and methods, accounts clerk might be required to draw up a list of unpaid invoices, any invoices that have not yet been paid, overdue invoices, invoices that were supposed to be paid but have not been paid, outstanding for longer than a certain period of time. So maybe an invoice that has been outstanding for 1 week, an invoice that has been outstanding for 1 month. So that is, we are talking of accounts clerk must be in a position to prepare that list. We have already talked of the methods of payment. So which methods of payments will we focus on? Cash, checks, credit cards, debit cards, which we had already explained the difference between these two in a previous unit. When we were looking at unit number 5, we looked at the difference between credit cards and debit cards, and then other forms of electronic payments. Other forms of electronic payments. Number 3, payment by cash. We should always try to restrict payment by cash, but we can never avoid payment by cash. So cash payments are made for small payments. You must restrict cash payment because of the disadvantages of using cash. Remember, why should we make cash only for small payments, not all payments? Because number 1, cash needs to be kept secure. So if cash is accessible to anybody to make any form of payment, it may not be secure. It can be easily stolen. So that's why we must restrict it to small payments, or what we call petty cash payments. And number 2, cash can get lost in the post. So cash can get lost any time. That's why we should avoid using cash. Number 3, it will be difficult to keep control over cash if it is used often in making payments. So it's very difficult to control usage of cash. That's why we should restrict usage of cash. And number 4, if there is no receipt that is provided, if cash payment is made, there will be no records. There will be no evidence. So if there is no evidence, it is very difficult to restrict payments. Now, we are saying that cash should only be used for small payments. Other forms of payments, we can have the option of using a check. So payment by use of check. So checks are for payments out of the current account of the business. The business has a current account with the bank. So checks are written, and checks affect what we call a current account. Number 2, an individual in the accounts department will be responsible for the safekeeping of checks. So there is one person in the accounts department who will be in charge of keeping checks. And checks must be kept under what we call a locker or under a safe if the organization has a safe. So it must be kept under lock and key. Always, all the time, checks must be kept under lock and key or a safe if we have a safe in the organization. Checks must have authorization or approving signatures. So signatures on business what? Checks. A bank will not permit a payment by check from a customer account unless it has been properly signed. Sometimes we can have only one signatory, but for larger payments, we can have 2 or more signatories. So there must be a senior person who can make the signing of the check. This can be the head of finance, or it can even be the chairman of the company, or even the CEO. Every organization has got a protocol on who should be signing the checks. So for company checks, only certain specified individuals within the company are permitted to sign the check. We have already talked about that. In many cases, checks about certain values must be authorized by 2 or more signatures. We have already said payments as above a certain amount must have 2 signatories in the check. And finally, authorized signatures for a company checks are selected by the company. It's the company to decide who signs the checks. It's the company to decide who signs the checks. What are the procedures for preparing a check? Number 1, prepare the list of payments. When you want to make payments, what is the procedure you follow? Prepare the list of payments. Number 2, payments should be authorized, and you only authorize if you have sufficient funds in your current account. Number 3, check invoices to be paid. And then if there is a payment, there must be a supporting invoice. Number 4, prepare the checks. Number 5, attach invoice to the checks. And of course, sign them, ensure they are signed, and then mark invoices that have been paid. Mark invoices that have been paid. What are the advantages of using checks? Number 1, checks are convenient to use for payments for any amount. You are not limited in the amount you can write in the check. Number 2, the check counterfoil and check number can be used to provide a useful method of tracing past payments. In a check, there is what we call a counterfoil. When you pull out a check, when you tear it off, there is a slip that remains in the checkbook where you write the details that were in the check that goes out. The disadvantage are there may be security problems, especially if there are cases of forged signatures. And number 2, checks can be slow method of payments. Checks can be slow methods of payment. In number 5, payment by standing orders and direct debit. Standing orders and direct debits are both payments method which enable the business to transfer money directly from the business bank account. Whether it's a standing order or it's a direct debit, it enables the business to transfer money out of the business. However, there are 2 key differences between a standing order and a direct debit. The first one is a standing order. Standing orders are for regular payments. Maybe you want to make payments over a period of 12 months, regular, and for a fixed amount. So which means Payments are maybe you are paying 1 million every month regularly for 12 months or for 2 years, and it is 1 million. It is a fixed amount. It can be used for rental payments and or payments of insurance. Next, in a direct debit, is the same as standing order. The only difference is number one, it is not for regular payments. So it can be today we've made the payment, next month we are not making the payments. And number two, the amount can be variable or fixed. The amount to be paid can be variable. And the other point, it is the customer, the person to be paid, who initiates the transaction, who requests for a direct what? Debit. While in a standing order, it's the company or the business. Automated credit payment systems. So which are the systems that we can automate? How can we make payments directly through a system? We can use standing orders, we can use direct debits, we can use it to pay salaries, wages, and some one-off payments. In one-off payments, we can have direct debits. Standing orders can be used for salaries and wages. Lastly, number 7, documents to go out with when making payments. So whenever we are making payments, there must be what we call a remittance advice. And number 2, there must be a covering letter. A remittance advice either created by the customer or as part of the statement sent by the suppliers. Some few examples. Number 1, which one of the following statements concerning direct debit payments are correct or is correct? Direct debit. Remember, direct debit is a payment which is irregular, and it's also, it can be variable. The amount is not fixed. The payment amount is fixed. It's not true. It's standing order if it's fixed. Number 2, they involve the use of checks. No, direct debits don't necessarily need, they don't involve checks. Number 3, the person who makes the payment initiates each payment. No, that's a standing order. Remember, it is the customer who initiates payment there. And D, the amount of the payment can be varied. That is true. So this is the correct answer. A direct debit, the amount varies. The second example question, which one of the following is not a characteristic of a standing order? A standing order, remember, it must be fixed and it must be regular. So A, which one is not a characteristic? Used to make regular payments, that's a characteristic. Number 2, the payment amount is fixed, that is a characteristic. The recipient of the payment initiates each payment, that is not true. That is true only for a direct debit. And lastly, the amount of the payment can be varied sometimes. It can be varied if maybe we alter in a certain month. The third question, what is a remittance advice? Remember, it's a document that supports the payments to be made. It gives instruction how much is to be paid. So what is a remittance advice? A document which is sent to a supplier containing detailed delivery instructions note. If it's detailed delivery instructions, that's a delivery note. Number 2, a document used to confirm a telephone order. That is not true. To confirm a telephone order, it can be a purchase order or it can be a sales order. Okay. Number 3, a document sent with a payment explaining what a payment represents. That's the correct answer. It shows what the payment should be. And a document prepared by a supplier on a regular basis listing the outstanding amounts and payments received. That is not true. The last question. Which one of the following are characteristics of direct what? Debits. Which one of the following are characteristics of direct debits? Direct debits used for regular payments. That's not direct. Which one of the following are characteristics of a direct debits? Let's see. Used for regular payments. Recipients initiates each payment. This is true. Number 2 is true. Number 3, amount of each payment is fixed. That is not true. And number 4, direct debit instructions is sent by the company to the supplier. That is not true. So the correct answer is direct debit is mostly used, recipients initiates, and the amount in recipients initiates each payment. Number 2 is correct. Amount for each payment is fixed. It may be variable. Number 3, direct debit instructions is sent by a company to a supplier. That is also true. So number 4 is true. Number 3 is not true. Number 2 is true. So number 2 and 4, the correct answer is B. The correct answer is B. And there is one more question, but that one you can attempt it on your own. So in this question, I can leave it for you to attempt it. That brings us to the end of this unit. We will meet in our next session, which will be unit number 7. Thank you.